You think your car gives you freedom. It gives you a payment plan that eats 30% of your income for 7 years straight. That is not ownership. That is subscription poverty with a steering wheel. And the system that sold it to you has been running this exact playbook since the day Henry Ford realized he could turn workers into customers by financing the product they built. This is not about cars. This is about engineered dependency dressed up as the American dream. Right now, the average car payment in America is $643 a month. That is $7,700 a year, vanishing into an asset that loses 15% of its value the second you drive it off the lot. You are not building wealth. You are renting your own escape route from a trap that resets every 7 years. And the moment you finish paying it off, the cycle starts again. Because by year 7, your car needs expensive repairs. Or it feels outdated. Or the dealership sends you a letter about upgrading. They know exactly when you are vulnerable. They built the calendar. Here is what most people miss. This is not predatory lending. This is systematic wealth extraction, disguised as convenience. The car payment is not the cost. It is the anchor. It keeps you working. It keeps you compliant. It keeps you exactly where the system needs you to stay. One paycheck away from default. And the entire machine runs on your belief that you made a choice. Let me show you where this model comes from. 1920. General Motors creates GMAC, the first captive auto finance company. Not a bank. A manufacturer that also lends you the money to buy what it sells. Henry Ford fought this. He called it debt slavery. He wanted workers to save up and buy cars outright. But Alfred Sloan at GM saw something Ford missed. If you control the financing, you control the customer for life. You do not just sell them one car. You sell them a 30-year chain of payments that never stops. GMAC was not created to help people afford cars. It was created to guarantee repeat revenue from the same person over and over again. By 1925, 75% of cars were sold on credit. This was revolutionary, not because it gave people access, because it turned durable goods into subscription income. The product became the excuse. The loan became the product. And once that model worked for cars, it spread everywhere. Furniture, appliances, homes, everything you thought you owned became something you owed. Then came the 1950s. Post-war boom. Eisenhower builds the interstate highway system. Suburbs explode. Cars go from luxury to necessity. And this is the key. The system does not trap you by making cars expensive. It traps you by making them unavoidable. You need a car to get to work. You need work to pay for the car. The infrastructure guarantees the dependency. And once dependency is guaranteed, the terms do not matter. You will pay whatever it takes because walking away means losing your job. Insurance companies saw this. They started requiring full coverage on financed vehicles. That is another $100 to $200 a month. Maintenance became more complex. Repairs required specialized tools and software you do not own. The dealership became the only option. And every layer added cost without adding escape. By the time you are 12 months into a loan, you owe more than the car is worth. That is called being upside down. And it is not an accident. It is the business model. This brings us to stage 1. The affordability illusion. You walk into a dealership thinking about price. They ask you what monthly payment you can afford. Not what the car costs, what you can pay per month. This is the shift. They are not selling you a $30,000 car. They are selling you a $500 a month obligation. And once you say yes to that number, they stretch the loan to make it fit. 5 years becomes 6, 6 becomes 7. Some dealerships now offer 8-year auto loans. That is 96 months of payments on an asset designed to last 10 years. You will spend 8 years paying for 2 years of value. And you will think you got a deal because the monthly number felt manageable. Then comes stage 2. The equity trap. You drive off the lot. Instant depreciation hits. 15 to 20% gone in the first year. But you owe the full loan amount plus interest. So you are underwater immediately. Now let us say you want to trade it in after 3 years. You still owe $18,000. The car is worth $12,000. You have to roll that $6,000 gap into the new loan. So your next car starts with debt from the last one. This is how people end up with $40,000 loans on $30,000 cars. They are not buying new vehicles. They are refinancing old mistakes. And every cycle makes the hole deeper. Stage 3 is where the system turns. The maintenance escalation. Years 4 through 6. Warranty expires. And tires need replacing. Brakes wear out. Transmission issues. Engine trouble. Suddenly you are paying the car payment plus $400 a month in repairs. You think about selling, but you're still underwater on the loan. You think about paying it off, but you do not have the cash. So you keep paying, and the car keeps breaking, and the dealership keeps sending you offers to trade in and start fresh. They are not helping you. They are waiting for you to crack. Stage 4, the psychological lock. By year 5 or 6, you have invested so much money into this vehicle that walking away feels like losing. You have paid $40,000 over 5 years. You are not going to let that go to waste. So you make one more repair, then another, then another. Economists call this the sunk cost fallacy. Dealerships call it customer retention. You are locked in by your own past payments. And the system knows you will keep paying because quitting feels like admitting you were wrong from the beginning. Stage 5, the reset, year 7, you finally pay off the loan. For the first time in 7 years, you have no car payment. This should be freedom. But the car is old. It feels outdated compared to the new models. Your friends are driving newer vehicles. The dealership has been mailing you upgrade offers for 6 months. And the biggest trick of all, you have been conditioned to that monthly payment. Your budget has adapted around it. So when the dealership says you can get into a new car for just $20 more per month, it feels reasonable. You have been paying $600 for 7 years. What is $620? And just like that, the cycle restarts. You sign a new loan, the clock resets to 0, and the 7-year trap begins again. Stage 6, the generational transfer. This is not just happening to you. This is happening to your kids. They grow up watching you make car payments. It becomes normal, expected. The first thing they do when they turn 18 is finance a car, because that is what adults do. Except they have worse credit, higher interest rates, longer loans, and they start the trap younger than you did, which means they will be trapped longer. The system is not just extracting wealth from you. It is teaching the next generation to accept extraction as normal. Now let me show you the math that makes this work. Dealerships do not make most of their profit selling cars. They make it financing them. The average dealer profit on a new car sale is around $2,000. But if they finance that car through their captive lender, they get a commission on the loan. Another $1,000 to $2,000. Then they sell you an extended warranty, gap insurance, paint protection, undercoating. Each of these adds $500 to $1,500 in profit. By the time you leave, they have made $6,000 to $8,000, not from the car, from the financial products wrapped around it. And here is the part that seals it. The loans are securitized, bundled and sold to investors as auto-backed securities, just like mortgages were before 2008, which means the dealership does not even hold the risk. They originate the loan, take the commission, and sell the debt upstream. So they have zero incentive to care if you can actually afford the payment. They just need you to qualify on paper. And qualification standards have been dropping for years. Subprime auto loans are now a $600 billion market. $600 billion in car debt held by people with credit scores below 600. The system is not screening for ability to pay. It is screening for willingness to sign. This is not a conspiracy. This is a business model. And it works because it taps into 3 psychological levers: status, necessity, and habit. You need a car to work. That is necessity. You want a nice car to signal success. That is status. And once you are making payments, it becomes automatic. That is habit. The system does not have to force you. It just has to make the default option feel normal. And payments feel normal because everyone around you is making them too. Let me give you the modern day check. If you are currently making a car payment, you are in the trap. If that payment is more than 15% of your take-home income, you are in stage 2 or 3. If you owe more than the car is worth, you are locked in stage 4. If you have ever rolled negative equity into a new loan, you have reset the cycle at least once. And if you are thinking about trading in before the loan is paid off, you are about to make it worse. This is not judgment. This is diagnosis. And most people are somewhere between stage 2 and stage 5 right now. Here is what the trap costs you over a lifetime. Let us say you start at 25. You finance cars every 7 years until you are 65. That is 6 cycles. Average payment, $600 a month. 600 times 12 is $7,200 per year. Times 40 years is $288,000. But that is just payments. Add in insurance, maintenance, registration, gas. You are over $500,000 spent on transportation. Now imagine if you took that $600 a month and invested it instead at an average 7% return. After 40 years, that is over $1.4 million. The car trap does not just cost you $600 a month, it costs you generational wealth. And the system depends on you never doing that math. So here is how you escape. Rule 1. Never finance a car for more than 3 years. If you cannot afford the payment on a 3-year loan, you cannot afford the car. Buy something cheaper. Rule 2. Never owe more than 50% of your annual income on a vehicle. That is the ceiling, not the target. Rule 3. Drive it until the repair costs exceed the payment you would make on a replacement. That is the actual break-even point, not when it feels old. When the math says replace. And here is the deeper play. If you can survive without a car, do it. If you live in a city with transit, use it. If you can bike or walk to work, do that. Every month you avoid a car payment is a month you get ahead. But if you need a car, buy used. Pay cash. $3,000 to $5,000 gets you reliable transportation. It will not impress anyone, but it will not chain you either. And the goal is not to look successful. The goal is to be free. The system will tell you this is unrealistic, that you need a newer car for safety, for reliability, for resale value. All of that is marketing. A 10-year-old Toyota will outlast a 3-year loan on a new BMW. And the status you think you are buying with that new car disappears the second someone pulls up in something nicer. You are not competing. You are performing. And the performance costs you everything. Here is the final piece. The car trap is not just about cars. It is training. Training you to accept debt as normal. Training you to think in monthly payments instead of total cost. Training you to prioritize appearance over equity. And once you accept it for cars, you accept it for everything else. The house, the furniture, the phone, the subscriptions. The entire consumer economy runs on your belief that payments are just part of life. But they are not. They are a choice, and you can choose differently. The average American spends 96 months of their life sitting in traffic. 96 months commuting to jobs they need to pay for the cars they use to commute. That is 8 years of your life spent maintaining the system that traps you. And the car is just the visible part. It is the anchor that keeps you from saving, from investing, from taking risks. Because you cannot quit your job if you have a car payment. You cannot move if you are underwater on a loan. You cannot build anything new if every dollar is spoken for before you earn it. The car does not give you freedom. It kills it. And it does it so slowly, you never notice until you are 65 and still making payments. If this opened your eyes to the cage you are living in, subscribe, because in the next video, we dismantle the rest of the illusion.